Markets thought the Federal Reserve was steady, predictable, and committed to staying restrictive. Then New York Fed President John Williams spoke last Friday, and suddenly the tone from the Fed flipped almost overnight. Today, I'm going to show you the charts that explain why the Fed panicked so quickly and what they're really seeing beneath the surface. Let's start with inflation, the metric the Fed hangs everything on. Williams said inflation is moving in the right direction and that the Fed must retain flexibility. This chart shows why. Core PCE is falling faster on a 3-month annualized basis than the Fed expected. Their models thought inflation would glide down, but instead it rolled over sharply. When inflation is collapsing and unemployment is rising, the Fed cannot stay tight. That's the first trigger. The Fed isn't panicking because of inflation. They're panicking because of labor. This is the JOLTS job openings chart. Job openings are falling at one of the fastest rates since the financial crisis, but unemployment is starting to creep higher. That combination terrifies central bankers. It's the exact pattern we saw before the 2001 recession and the 2007 recession. Temporary employment, one of the Fed's favorite leading indicators, is rolling over hard. When temp work collapses, full-time jobs typically follow within a few months. Williams's tone changed because the labor market is cracking faster than they admitted. This part didn't make headlines, but it's exactly what the New York Fed, Williams's shopper, monitors. These spreads widened in a way that suggests stress in short-term funding markets. Not a crisis, but a warning shot. When the plumbing of the financial system creaks, the Fed moves fast. That's why Williams emphasized policy flexibility so forcefully. This is the chart that really matters. The Fed suddenly realized we're tighter than we thought and tightening even further by accident. They cannot afford a policy error. Look at commercial real estate maturities. Trillions are rolling over at rates the underlying properties can't support. Delinquencies in office and retail are rising. The Fed sees this. They know higher for longer risks a credit accident. High yield spreads have started to widen, not dramatically yet, but the Fed knows the pattern. This is how cracks begin. Here's the timeline. 2 weeks ago, they were still talking tough. Last Friday, when Williams spoke, the tone flipped to, we are not on a preset course. We need to retain flexibility, and we must not keep policy too restrictive for too long. That's Fed speak for, we see the data, we see the risk, we're preparing to pivot fast. When the Fed panics, the yield curve steepens, and that's exactly what it's starting to do. A steepening curve historically means rate cuts are coming, recession odds rise, and liquidity shifts. Stocks may rally on the pivot talk, but credit markets and labor data tell another story. Fed funds futures now show a completely different path from just a month ago. The market is pricing the Fed's fear, and Williams' comments confirmed it. The Fed didn't just pivot, they panicked, because beneath the surface, the data turned faster than their narrative. If you want breakdowns like this, clear data-driven with no noise, make sure to follow for more.